sizzling stock rally is about to end, as investors are realizing how quickly the Fed's rate hikes are crushing the economy. We are heading into the most crazy week, both in earnings and macro, with the Fed. Volatility is set to explode. Wednesday, we have ISM manufacturer PMI, FOMC statement, and the Fed funds rate, expected to go up 25 basis points. What if they do 50? We always get huge spikes up or down during FOMC press conference. The major topic for this Fed meeting is only one question: how quickly rate hikes has crushed the economy. For earnings, we have big techs like Meta, Apple, Amazon, AMD, and Google all report this week. Trillions of dollars of market cap at stakes here. We have non-farm payroll and ISM service PMI on Friday. Those are most likely to move the bond market and TLT. Are you ready for some fireworks in the market? How quickly rate hikes has crushed the economy. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get it into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? Fed's interest rate strategy in 2023 hinges on how quickly rate increases crush the economy. Moderating the pace of rate rises would give the Fed more time to study the effects of its moves. Federal Reserve officials' deliberations this week over how much to raise interest rates will hinge on how much they expect the economy to slow this year. Key to those discussions at their two-day policy meeting will be estimating how much their previous rate increases will cool growth and inflation over time. There will be a lot of thinking about, are the effects we're getting about on the track that we expected? Are they coming sooner or are they coming bigger? Said William English, a former senior Fed economist who is a professor at the Yale School of Management. Fed officials are lifting rates to lower inflation by restraining growth. They are likely to raise their benchmark federal funds rate on Wednesday by a 1/4 percentage point to a range between 4.5% and 4.75%, extending the most rapid adjustment in interest rates since the early 1980s. If the legs are long, last year's rate increases are just beginning to work their way through the economy and will strongly curb economic activity in the year ahead. That implies the Fed doesn't have to raise rates much more or keep them high for very long. But if the legs are shorter, the previous hikes have largely taken effect already, and the central bank could decide it has to raise rates higher or hold them high for longer to achieve the desired effect. Moderating the pace of rate rises would give the Fed more time to study the effects of its moves. A quarter-point increase this week would slow them for a second consecutive meeting, after officials raised rates by a half point last month and by 0.75 point at 4 consecutive previous meetings. Many investors think the legs are long. They anticipate the Fed will cut rates later this year and through 2024 because they think it has already lifted them to levels likely to cause a recession. As a result, medium and longer-term interest rates that are determined by markets, including for most U.S. mortgages, have stopped rising or have fallen even though the Fed has continued raising short-term rates. Economists at Goldman Sachs see shorter legs. They say markets' pessimism is overdone, and they are among those who think the economy will prove more resilient than anticipated, which could call for a longer period of higher rates. While the consensus worries that the lagged effect of rate hikes will cause a recession this year, our model says the opposite. The drag on gross domestic product growth from monetary policy tightening will diminish substantially in 2023. They expect to see a similar effect this year from reduced federal government spending last year. Some Fed officials say interest rate moves influence the economy faster because they communicate their policy intentions far more explicitly than in the past. 30 years ago, for example, the Fed didn't tell the public whether it had made any rate changes at its meetings. The market had to go figure out that the Fed was in there doing something. In that world, policy takes a while to influence the economy. Fed Governor Christopher Waller said earlier this month, by contrast, today's Fed provides guidance about its coming moves, shortening the legs. I think we're seeing a lot of the impact for monetary policy coming through in the next quarter. Others say this overlooks important changes that have extended the legs. Even if Fed officials have shortened the time it takes between changing its benchmark rate and influencing financial conditions, they haven't shortened the time it takes financial markets to influence economic activity. Those secondary effects may be taking longer now than in the past because of world crisis fueled distortions. In 2020 and 2021, the government's response to the world crisis, showering cash on households with stimulus spending, and reducing borrowing costs for consumers and businesses prevented the usual crisis pattern of rising joblessness that amplifies declines in income and spending, triggering a recession. That left private sector balance sheets in historically sturdy position. We're in a different world from the last several business cycles. The last several cycles haven't had world crises and land wars in Europe. Rate increases can slow the economy more immediately when economic growth is being fueled by credit growth, as opposed to income growth, and government stimulus, which were the big drivers in the post-world crisis recovery. The upshot is that this time, it could take longer for the Fed's moves to be felt through the economy. Consumer spending and income growth slowed at the end of last year. along with the slowdown in inflation. The Commerce Department reported last week that one gauge of underlying demand, final sales to domestic purchasers, which exclude inventories and trade, rose at a meager 0.8%, seasonally adjusted annualized rate in the fourth quarter. If you look under the hood of the economy, it is clear things are slowing. Things are grinding down. The Fed's rate moves didn't slow the economy as much last year as might have been anticipated, because the economy was still buoyed by fiscal and monetary stimulus that was supporting activity. Fed Vice Chair Lael Brainerd said in a speech this month, "It is likely that the full effect on demand, employment, and inflation of the cumulative tightening that is in the pipeline still lies ahead." The construction sector offers a clear example. Strong demand for housing during the world crisis, together with ultra-low borrowing cost, ignited a building boom. The Fed's rate increases crimped demand, but supply chain bottlenecks and a burst of apartment home construction, which is at a 50-year high and takes longer to complete than single-family housing, means the construction industry hasn't had to lay off workers. We haven't lost a single job in construction. We have these enormous backlogs that are being worked through. Around the middle of the year is when we're going to feel peak pain. Large companies have been resilient to the Fed's rate hike campaign so far, because before it began, they were able to lock in low borrowing costs for several years in corporate bond markets. Small businesses, by contrast, could face more pressure this year from higher rates because they rely on bank loans or shorter-term loans that will face higher borrowing costs sooner. Consumer spending will be one key to how much the economy slows this year. Households so far haven't pulled back much in response to higher inflation and rising rates, partly because many accumulative large savings earlier in the world crisis. Low-income consumers have likely exhausted those buffers because credit card borrowing is rising. She expects many more households to have depleted their savings by November, curbing their spending. Mr. Miracle of Goldman Sachs sees less reason for consumers to retrench because inflation-adjusted incomes are set to rise if overall inflation continues slowing. With price increases taking less of a bite out of household paychecks, it's just not realistic to be drawing down excess savings to same degree in 2023 as in 2022. Don't expect a soft landing. You can open to prepare for a soft landing, but don't expect it or you will get crushed. In 2007, the Fed actually said the same thing. They told investors that they are aiming for a soft landing. Obviously, they were wrong, as they were wrong about inflation was transitory, even though they sold it at the top in 2021. And this is my client's collaboration book, such an amazing book with such incredible authors. It's called It's Already Yours, Adversity Equals Success. And my book, Rainbow Focus. If you'd like to order a copy, we will post the link below in the description. It will make an absolutely amazing Valentine's Day present for that special someone. And so order your copy today for Valentine's Day. You are such a good boy for watching my video right till the end. Bye.